Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morja.
Hello, listener, and welcome to the show. I'm your host, Dave Morja, and today is another episode of Between the Sheets with Rob Beardsley, COVID edition this time. So welcome on the show, Rob.
Yeah, thanks for having me.
Yeah, and not used to our typical setup usually, like we talked about. We're sitting in some nice living room lounge, something like that, talking in person, making it a little more visually appealing. But, COVID madness, we're a little bit more remote today, so we'll trudge through it. And keeping on that theme, we're going to be kind of talking about the effects that some rules with COVID have rolled out as far as debt servicing and a lot of other good things. Not necessarily good, but a lot of other different things, I'll say. We're going to just hit on those today. So Rob, you want to just kind of highlight maybe some of the changes that we've seen over the last month or so with these doomsday related changes that the lenders are kind of dishing out?
Right. Yeah. So I think high level, the thing that's happening today is just a drop in transaction volume, right? There already was a slight disconnect between buyers and sellers pre-COVID and just because of valuations being so high. And now you've had a few factors that have really brought on a decline in valuation from a buyer's perspective, yet sellers are still looking backwards at yesterday's price. And so that's created an even bigger gap, which is why we've seen all the pricing come down. And to add to it, like you said, the lending front, a lot of lenders have just fallen out of the market. And then the shining light, Fannie Mae, Freddie Mac, who are still in the business and are still actively providing capital to the market, are doing so at different terms, certainly from a leverage perspective. And then the big headliner are reserves. So to ensure debt service is made and to keep the lenders safe, they're instituting anywhere from 6 to 18 months of reserves, which could include a full years of property taxes, insurance, interest, principal, and replacement reserves. So this is something new to the market for sure, and can even be up to 10% of your loan balance. So imagine getting a 70% loan to value loan, but day one, you only get funded 60% of it. So that can really change the equation a whole bunch. So later, we'll dive into that and actually see what is the price adjustment I need to get. Is it 1%, 5%, a 10% price decrease to get back to my original returns based on these new loan assumptions? And then also we'll dive into the few key metrics that you can focus and stress on to alter your pre to post COVID underwriting, if you will.
Yeah, and it's kind of important to mention that cap, just kind of if you take to the extreme and say you had to hit that 10%, and we'll get into the details in a minute, but just really quickly, if say you're raising 30% of the property value, the acquisition price for the capital raise and the equity down and the capex, if you add another 10% of that, you're looking at diluting shares from 33%. So you can really see quickly how you're just really kind of kiboshing a deal. So let's kind of get into it. Where do you want to start, Rob?
Yeah, I mean, we can talk about the high level underwriting tweaks, and then from there we'll just dive into the spreadsheet, into all of that we'll talk about. So let's start with underwriting. So something that a lot of people have been talking about from the very beginning of COVID is, how are you underwriting differently? Are you all of a sudden underwriting with a 10% vacancy factor instead of a 5? Are you throwing your value add plan out the window and assuming a stable deal that you're not going to raise rents on? So I think a lot of people have these questions as to how to proceed. And being on the acquisitions front, we have to have a slightly optimistic view on things, or else we're never going to buy anything. And that holds true in today's environment, yesterday's environment, at all times. People who buy something are buying something on the premise that things will get better later. So to keep up with that, we want to be in the market, and we want to make acquisitions that make sense, yet are still conservative enough that we're protected. So the way to do that, in my opinion, is to really stress 3 main factors in your model. And those factors are stabilization timeline, your going in vacancy rate, and your hold period. And you can also play with rent growth, but we're typically conservative on rent growth anyway. So, I don't necessarily want to get too much more pessimistic there. So to start with, and then we can kind of get into some discussions on it. The stabilization timeline, I think, is one where people are pretty aggressive on this anyway. So it's good to cut back on this and be conservative, right? A lot of people might be looking at a deal where they think they can turn all the units and get their rents up in 12 months. I would say, because of COVID, you probably want to look at 24 months, right? Just because we might have a period of time where it may not make sense to spend your CapEx dollars and you're better off just holding still and playing it safe. Another one that we talked about is the going in vacancy. So some properties are experiencing declines in collections and some are, pretty not feeling any effect. I think nonetheless, it makes sense for that 24-month period of time initially, go in with a higher vacancy rate and let that slowly get back to normal, rather than going in and saying my new normal is 15% vacancy, because then you're never going to buy the deal. You have to assume that we return to some normal at some point. So I think stressing the interim as well as how long it takes to get to normal are important ways to go, that you can still actually evaluate a deal without completely crushing the numbers.
Yeah, and that's an interesting way to kind of anchor it if you assume that your rent growth is already conservative, and then you kind of drag that number down by upping the vacancy rates instead, that temporary kind of pull down, like you're talking about, maybe 15%, and then slowly edge that back up. So now you're at, your typical economic loss you'll see in maybe a year or two, whatever that timeline you feel is comfortable. That is a way to kind of accomplish that versus saying, really killing the rent growth, where, like you say, you just won't really find a deal. And not that you should be pushing deals across your desk and closing on stuff you shouldn't be, but there has to be a limit there too to actually acquire something. So yeah, that's an interesting way, and probably a really clever way to make sure you're still being conservative while aggressive at the same time, if that makes sense. And then
right.
Go ahead.
So the other thing is, obviously, from a sponsor perspective, the holdbacks from the lender are painful. Like you said, if you look at it from how much equity you have to bring to the table, that could increase your equity raise by 20%, right? It could increase by 25%. And obviously that's painful. But on the flip side, that really should give you the confidence that you'd be able to ride out a storm. I mean, if you think about it, you're going to have potentially twice the 2 years worth of debt service or more. So if you could just pay no interest on your mortgage monthly, I mean, you'd be able to ride out a pretty much any storm. So I think that really gives you the confidence that if you long-term are bullish on the deal, that those reserves, whether you like them or not, are really going to help you survive and get to the other side. And like I said, depending, even if the other side is in 24 months or in 5 years, which I don't think that's going to happen. But that brings me to the stressor, which is the hold period. So one of the ways, as you know, to get aggressive on a deal is to assume a shorter hold period, that you're going to get all your renovations done quickly and you're going to be able to make that exit happen sooner, which bumps your IRR. And so I think extending out your hold period by at least 2 years is one way to kind of dampen the returns of the deal, which at the same time will raise your return hurdle and lower your pricing. So, and it's not really, we're not even changing any numbers in terms of payroll and repairs and maintenance. All we're doing is pushing out the hold period, because it's a way to be conservative, that I might be stuck in this deal longer term. And do I still like my return if that's what happens?
Yeah, and that's an interesting point too, is you don't want to, force your own hand, especially in a time of turmoil. I'm sure there will be some deals coming out in the next quarter where people are forced to sell, and it's going to cost them because they really should try to hold on through this kind of turmoil. And you mentioned extending that by even a couple of years. So just off the top of my head, that brings a couple differences as far as debt you should be acquiring. And I have a couple ideas, but I want to see where you kind of take this. But ignoring, a 5-year versus 7-year debt product, what other things would you be kind of looking at where you'd be saying, check this box, don't check that box, as far as terms you'd want on that debt that you would not normally look at or be attracted to?
Yeah, that's a good question. I think the market, especially when you're talking about Fannie Mae and Freddie Mac, but also CMBS, they really push you towards the 10-year loan term. That's their sweet spot. They're going to make the terms typically most attractive for that loan term. So whether you like it or not, you're most likely going to take on 10-year debt with yield maintenance, which a lot of people don't. A lot of people, don't really think much of it. But it is something that's something you should really think about.
It's exactly where
And
I wanted you to go.
Yeah. Yeah. So, I mean, we just locked a deal at a unbelievably low interest rate with yield maintenance. And that's kind of the trade-off. Do you want to get the most proceeds, and do you want to get the lowest interest rate? Because if you do, you're going to have yield maintenance. So if you have the luxury for maybe taking on a little less leverage and having more prepayment flexibility, you'll be able to get that through a declining prepayment penalty or a floating rate loan product, which I really like floating rate loans, because if you look at the data out there, floating rates over the long term actually end up being cheaper than fixed rates. But there are other things that play in the market that make fixed rates in the end more favorable. So that's coming from me, who I like floating rate debt, but end up in fixed rate most of the time. So I think yield maintenance, it's a unique situation today because you're locking in at historically low interest rates. So it's highly unlikely that your loan is going to be a dog loan when you're going to sell the property on assumption. But that's often what can happen. And we've seen deals that maybe they put the loan on in 2015 or 2016 and interest rate is around 5%, or I've even seen 5.8%, and they're trying to sell the property subject to that loan. And I mean, we're assessing pretty much a 20% discount to market value based on the loan. So that would be a classic example of good company, bad balance sheet. And that's the biggest thing you want to avoid when you're locking yourself into a loan without flexibility. But I think today there is a strong argument to be made that if you're talking about a Fannie Mae product that has a supplemental loan program, and you've got a super low interest rate, I don't think you're putting yourself at a huge disadvantage.
Yeah, and again, this circles back to what Fannie and Freddie are trying to nudge us as buyers to do, right? You talk about the interest rates are low right now. You talk, they're pushing you to kind of extend that horizon for your debt. So you look at the 7 years and 10 years, and now all of a sudden the yield maintenance is more of a no-brainer. And not necessarily going to be the case every time, but now it's starting to, really make sense where this might be the decision you make because you're really looking to hold. And if you close on a deal right now, it's really likely a home run because you raised all that money and are able to have all this reserves. So you really should be, like you said, pretty confident to, even if you have to, forego some income for 6 months or even a year, still be able to weather the storm and come out kind of all roses and sunshine. So kind of going back to what you said, Rob, about the raise and kind of the draw for construction. You mentioned that your period is going to also extend for that too. You could just kind of go back and explain a little bit more on why that was the case?
In terms of extending your stabilization period?
Yeah, stabilization period, yeah.
Yeah, I think it's just the conservative thing to do because there's so many factors that could delay your value add plan. For example, the economy could just be depressed and bumping rents $100 or $150 could be off the table just because your tenant base is not looking for the higher quality product. They're just looking for affordable rents. So I think it may take time for the demand to be back there in the user market for value add. And then on top of it, I think that's probably just the biggest factor is just, it's going to take more time for the economy to recover, and factoring that into your model through a longer stabilization period rather than throwing away the rent growth or rent premiums through renovations is a better thing to do. The other thing to do would be to kind of put a pause on it and just assume that you're going to start your increases and your renovations in a year or 2 years, and that would also work.
Yeah, and then there's that kind of in between, right, where you can almost kind of determine what's going to be the highest use of my dollars that you've raised for CapEx and figure out, what can actually raise my rents today and what is going to have to wait, that if I put the money in now, it's not going to really make a difference. And that probably would lend to most of the interior renovations, right? Typically, that's what's going to ultimately get a renter to kind of see the value in a property. Obviously, your outside amenities and all that stuff has to have a certain level. But really, the interiors where they're going to be spending most of their time would probably be what you would want to hit first, right? I mean, that's my thesis on that, to kind of bring those rents up as far as what you're going to at least be able to do in the interim.
Right. And it also depends on your business plan. And because you may be in a situation where prices may come down to the point where you like a deal enough that it has value add on it, but now it's just not the right time. But the returns themselves without the value add are good enough to jump into the deal. And what you can do is you could really focus on everything but the interior value add, making sure that the property is in really good shape, well managed, strong tenants. And that way, when you get to the other side, you have two options. You can call capital to perform now the interior value add, or you could sell the property at a compressed cap rate because you're going to be selling it to a value add buyer.
Yeah, that's an interesting consideration I didn't really think of. And then I guess you just kind of have that in your pitch deck to your investors that you're going to be looking to potentially raise this money. If all goes well, or if Plan A happens, you're just going to be flipping it essentially in a couple of years. So yeah, that's an interesting play too. I never really considered that.
Yeah, absolutely. I think, and then in terms of talking about bridge loans, we've seen many bridge lenders go out of the market, and then because of that, bridge terms have widened substantially. They've really been able to command the market, and pricing has gone way up, even as interest rates have gone down. And we've seen LIBOR come down substantially through this period, and that's so. The tricky thing is if you have a value add plan, finding the right bridge loan is challenging for sure, but then also having the confidence that if your bridge loan only has a 2-year term or a 3-year term, that you'll be actually able to buy the deal now and implement your value add and then exit that bridge loan in time. So I think that's really challenging, and it's not something that we're seeing a lot of today yet. So I think the better opportunities right now, and I was saying this pre-COVID, but finding bad deals where you can assume a decent loan, that's actually not a bad way to go. And then to take it a step further, then you could get into the note business of buying a non-performing note and then working out with the borrower, potentially take possession, things like that.
Yeah, and that way you're not really getting to the forced appreciation model. You're just getting into the model where you can kind of pull the financing levers instead of worrying about rent increases, which during these times, I mean, rent increases or rent decreases or just kind of rent market is going to be, vastly changing, and no one really truly knows where it's going. So that could be a way to get out of that mess too. Yeah, that's a great point. Go ahead.
Well, I was
There's a
just going
little
to add,
delay.
it's really crazy times. I mean, if you look at some CoStar reports right now, if you're looking at a particular property, that might say CoStar is projecting for the submarket to have negative rent growth of 10% over the next year. I mean, nobody wants to plug that into their model. That's so painful.
Exactly. Yeah. I mean, you'll be looking at even more deals. It used to be it depends on the market, but a couple hundred to get one deal closed, and that'll skyrocket if you start doing that. So yeah, I got to find that balance for sure. Is there anything else we want to kind of hit before we get into some of the modeling?
Yeah, let's just dive in.
All right, let's do it. Yeah, so here we are back in Rob's model. We're gonna just kind of get into some of what we talked about as far as the vacancy that we can kind of ramp up or ramp down rather, and then we can kind of work with how we're gonna look at the debt and reserves that were gonna be required for Fannie and Freddie. So yeah, what's first, Rob? Where do we want to hit? I guess highlight the deal. Yes. Maybe.
Yeah, exactly. So this is just a hypothetical deal based loosely off of a project that we looked at in the past. And as you can see, with some tweaking and a wishful thinking price, we got to a pretty good IRR. So this I would consider to be a good deal. And some assumptions here we're making is 75% loan to cost leverage at 4% interest rate, 3 years of interest only. And so you can kind of get a sense of how this deal looks in terms of the cash flows and the return metrics. And now we'll dive into some inputs and change just the debt assumptions and see how things change. And so note over there that we have a purchase price of 11.9 million, which is 90,000 per unit for this deal. So let's just go ahead and start tweaking some stuff. So if we bring down the leverage to 70%, because that's what's happening is higher DSCR constraints and lower LTVs. So, however, interest rates are down today. So let's assume 3.5%. So we're able to save money on interest today than before, but we're getting less leverage. So those are some small tweaks there, but the big one is the holdback, which, as we talked about before, could be up to 10% of the loan. So if I do something quickly, like let's just make this equal to a year's worth of property taxes plus a year's worth of insurance plus the replacement reserve, plus we have to go over here to our pro forma for the debt. They want principal and interest. So I'm going to go to a principal and interest 12 months worth of payments and add all that up. That's $820,000, which is, if we look at the loan balance of 8.6 million. Yeah. So we're right there in the ballpark of up to 10% of the loan. So let's take a positive, optimistic case where we don't touch this reserve and it gets released back to us after 12 months. So here in year 2, we're going to project a negative expense equal to this reserve. So that just means all this reserve is going to be refunded in year 2 after 12 months. So hopefully that makes sense. So really there's no money lost. There's just shifting of time and money. So it just means more money has to be brought to the table in equity day 1, but you get it back in year 2. So now let's look at the returns. So the returns dropped from 18% to 15.8%. And I mean, the cash flows, the way we built it's a little wonky because now it looks like our year 2 cash flows are really big, but really we had a big return of capital. So I say the big thing to focus on is what if we want to get back to 18% IRR in this scenario? So let's just say instead of 90,000 per unit, we need to go 85,000. That gets us up to 19. So we really only need, let's say 87. And that gets us back. So you can see 87 is about a 4% discount on 3.5% discount on the price. So that's not a huge change. So that gives you a basis of understanding that if all else being equal, prices need to go down by roughly 5% just to accommodate for these changes in debt assumptions.
Yeah, and the keynote there is all things being equal, all else things being equal, because we're not even talking about the rents yet. So this is just talking about the requirements for Fannie and Freddie debt if you were going to play ball with them, basically. So 3% right off the top, and obviously that number is going to change, 3.5%, 4%, could be more, could be less, but just that's some good quick math on how you can kind of bring your project back to where you were looking for as far as your risk return. So
exactly. So now, like you said, let's dive into actually the fundamentals and the operations of the deal, which if we want to change the way we're underwriting, we need to adjust for current fundamentals. So the highlights that we talked about are stabilization timeline, going in vacancy rate, and then the hold period. Obviously, we could stress a bunch more stuff, right? You could say, well, my exit cap rate is going to be higher. I'm going to project flat rent growth and all that kind of stuff. But we just want to focus on a couple key metrics that we can really work with to get comfortable with deals in our new environment. So for starters, like we talked about, let's just take this to 24. And then obviously this deal, our hypothetical deal, has been performing well at around 5% vacancy, but we're going to assume that there's going to be some dip in collections and there's going to be maybe some concessions that need to be given out. So to adjust for all that, rather than nitpicking at each line item, we're just going to assume an increase in economic loss. So we'll just take this up to 10. And just to give some background as to how the model works here, these 24 months of stabilization, there is no rent growth during that period of time. So if you scroll down here to your annual rent increases, which is very hot topic and what makes deals work, and it's why people invest in real estate, we have no rent increases during that 24-month period of time other than what is being projected in the value add program, which you can find in the unit mix in terms of what are current rents today versus our pro forma. That's what's going to take place over the 24 months, but no rent growth. So to some people, that sounds good. To some people, maybe that's not conservative enough and you need to actually throw these away. But I still believe in the business plan. And if you're buying a deal, you should also believe in your business plan. So on the going in vacancy rate, over the 24 months, this 10% is going to linearly trend up to 6%. So it won't be 10% over the full 24 months and then just pop up to 6. It's going to, like I said, linearly trend over that timeline up to our stabilized assumption of 6. So lastly, we've got the hold period. So from 5 years, we'll just increase it to 7. And what you'll see now, we just made those 3 changes and our IRR went down from 18.1 to 15.1. So we didn't destroy the deal, but we're definitely asking more from the deal. And that's a way to not only protect ourselves by reducing our risk by getting into the deal at a lower basis, we're also, potentially setting ourselves up for higher returns in the future. So the way we need to do that is we need to get to a lower price that's going to get back to 18. So let's just guess here. I'm going to say something like 80,000 per unit.
That's what's going to be mine. Yeah.
We're overshooting a little bit.
Short. Yeah.
Yeah. So 81,000. Wow, 81,000. So this deal is pretty resilient to my stress. So perfect, right on the money. 82,000 per unit. So, assuming, so if we go 82,000 off of 90, so now that's a 9% decrease. I would say that's a pretty modest decrease, 9%. That's not a big correction. The problem is this hypothetical deal wasn't, the seller wasn't valuing this deal at 90,000 per unit pre-COVID. They were valuing it at 100,000 a unit or 105,000 a unit. So basically we're 9% off of what we were previously valuing deals, but we were in this market or pre-COVID, we're already down 10 to 20% off of, sellers' valuation. So I think that's really representative of the gap, this bid-ask spread that we have today. And I don't know which way it's going to be resolved because and I'd love to get your thoughts on this, because there's 2 ways to fix the gap, right? I mean, obviously they could be a meet in the middle, but you could have sellers capitulate and all of a sudden sellers get stressed. They run out of their reserves. Things aren't doing so well and they want out at any price. And then that gap will be filled by the sellers coming down. Alternatively, we could have a V. Lenders could get aggressive again. Reserves could go away. Buyers are in the market, inflation is on, and then buyers will fill the gap and we'll just come up to sellers' pricing. So yeah, what do you think on that?
Well, I mean, this is kind of getting outside the realms of just real estate because you're seeing a lot of injection of capital into the market, this quantitative easing and all this stuff. So it's hard to say where it's going to go because, it's hard to say what Jerome Powell and everybody at the Fed is kind of doing to help keep everybody from going crazy and scared. At this point, I think it's a little early to say that we're going to kind of make that V shape. I mean, obviously, that's what everything's kind of looking like right now. Everyone's kind of content again. But if you were to ask me, I think there's going to be that stress in the next quarter or two, definitely on the real estate side, where you're going to see some deals kind of go under, like you said, because of the debt stress. I think it's just going to be a little bit longer of a road for real estate, and it's going to be a little bit more of a wait and see pattern for the buyers until they're feeling okay. We're talking about kind of some things here that we haven't really. I mean, we hit vacancy, we put it down to up to 10%, but you're going to see some buyers be really scared to make that any lower for a long time, I think. So I would probably go with kind of option A on your 2 options there if you were to have it be an A/B choice, where I would say it's going to be a little bit more of kind of stress on the sellers because everyone just kind of on that hold pattern like we're seeing. I think that's going to continue on for at least 3, 6, 9, 12 months. So
yeah, I agree. I think that's where the opportunity is going to be. And if I were to cop out, I would say it's probably going to be somewhere meet in the middle. Like everything is going to be a compromise.
Sure. Yeah.
But it's going to be some interesting times for sure. So yeah, that's all I've got for us in the spreadsheet. Just a quick couple fixes, or tweaks, if you will, in the model, rather than throwing your pre-COVID models away and saying, let's say a deal that you looked at previously comes back around on your desk and says, well, seller previously wanted 120,000 per unit, but now he's gotten more realistic. He's at 110 now. You can, based on what we did here, you can roughly kind of guess what the deal is going to look like, assuming you underwrote it previously and have those assumptions there with you. But you can just quickly, make these tweaks like we did rather than throwing away the model.
Yeah, and you highlighted earlier. I just wanted to stress it one last time before we hop off. You mentioned this was only ended up being, it was only a 9% decrease in your bid for the property, and that's, like you said, not that large. But the difference would be whether you were far enough from the ask before this COVID situation happened. So if you said, like you said, if you were 10% off the ask or the whisper price, and now you add another 9, now you're, not even really in conversation. But if you have a home run deal, in theory, this is not going to really affect your property too much. It's really just going to be a shifting of the capital, like we kind of spoke of. It's just delaying the return of the capital versus completely eliminating it, because a lot of these things are just, you buying more debt, buying less debt, having more equity, and just kind of shoring up some capital for reserve. So it's really not losing money necessarily. I mean, yeah, there's vacancy losses, but it's really just kind of that delay of your capital. So it really doesn't have to kibosh a deal. Obviously, if you're close on something, it doesn't necessarily eliminate you from having something there. So definitely a good visualization of everything.
So another thing I'll quickly point out is, generally speaking, deals will be getting done at lower leverage. So in that regard, you're going to have less risk coming from your debt. So if we're solving for the same return metric of, let's say, 18%, but we're doing so with lower leverage, we're essentially, in that regard at least, getting a better risk-adjusted return. Now, obviously, there's other risks in the market that have materialized that could make this a worse risk-adjusted return, but that's something that is definitely positive and should be factored in. So we are, because other people could be saying, well, I previously wanted an 18% return on this market, but due to all the uncertainty and risks, now I'm out in the market looking for a 22. And that's definitely one way to go. Can't argue that. But you could also recognize the fact that your 18 is now getting accomplished with lower leverage.
Yeah, exactly. If you have a property you're looking to acquire, and say you're not even going to make the value up later right away, but say you're, over $100 under market rents and all these other things that are really making you confident in the fact that your income is not going to get hit as hard as everyone else, that vacancy isn't going to be too large at first. All things considered, you're looking at more of a better risk-adjusted return, like you said, and you can kind of be happy because you have all that reserves and that debt is smaller. So yeah, that's a great point as well. Yeah, so I think that about wraps it up, Rob. We'll call it a day for this one. I hope you enjoyed this COVID remote episode version of the Between the Sheets series. And I always stress, if you want to check this out on YouTube, I kind of said this at the end, but if you were listening to this just on the podcast, I really recommend you kind of hop on and watch the modeling of this. It's easy enough to follow through, but it really helps to kind of see the numbers and see what can kind of pop and change on these deals. So with that, thanks again, Rob, and I'll see you next time.
Thanks.
Thank you for listening. This has been the Making Money in Multifamily podcast. If you have any questions, comments, or would just like to connect, please feel free to check out the show notes for how you can connect, or visit longviewacquisitions.com.